everybody, and welcome back. Today with me there is Wenchang Ma from 91 Asset Management. Wenchang is managing the China equity portfolios of 91. Welcome, Wenchang.
Hello, thank you.
Wenchang, the world looks to China and on Chinese economy. So how far is China on the way back to normality?
China was the first country to have reported large-scale outbreak of the coronavirus. The government took very decisive measures very quickly and mobilized resources across the nation to fight the health crisis. We think the early intervention has proven to be quite effective, and the country is ahead of the curve in terms of its recovery so far. Looking at various high-frequency data such as the coal consumption, major city traffic congestion, and also car sales, restaurant reopening, etc., these are suggesting the economy recovery is well on track. Manufacturing activities are largely back to normal, but consumption and services take longer to recover to last year's level. We think this is mainly because there are still some social distancing measures in place in several parts of the country, and also people are reluctant to resume some of the old spending habits, either for health concerns or are worried about the prospect of their income. But the Chinese government has been doing a lot to help to reboot the economy. For example, there are increased infrastructure spending, reducing taxes and fees. Those are all examples of the fiscal stimulus measures. It has also been loosening monetary policy, which is also very helpful. Given the strong starting point, I think the Chinese government actually still have a lot of room to put out measures to support the economy. So China is on track for recovery from coronavirus.
So we have seen a strong bounce back in Chinese stock market. So what are the drivers behind it?
I think there are several reasons behind that. The first reason is probably that investors could see China is the first to come out of the coronavirus crisis. Its reopening is ahead of other major economies. The coronavirus is causing disruptions to the global economy, and also corporate earnings face in general downward revisions trend across the board. But the impact on Chinese firms are less severe, and China's earnings revisions are less steep. I think the second reason is that China has a large and a very comprehensive domestic economy. Over the past decade, we have seen China reducing its reliance on export. I think having comprehensive supply chain inside the border means that there are many companies whose businesses are actually not exposed to international trade disruption. So that's very helpful. And thirdly, China's equity market is largely driven by domestic investors. In this environment, there is an abundance of liquidity, there is capital control, and also home buyers, which have been helpful in keeping the funds in the domestic market. Foreign investors only account for less than 10% of the total free float on the China-Asia market anyway. And last but not least, China equity market has its long-term strategic value for global investors as well. It provides diversification benefits, and it also has attractive growth at very reasonable valuation level. Chinese equities have been underrepresented in global asset allocation for a long time, but as China consistently opens up its markets, major index inclusions are taking place, and we see both active and passive investors are increasing their asset allocations into China. Just for an example, year to date, the Stock Connect northbound flow into A-shares has reached $13 billion US. So I think all these are reasons that have supported the outperformance of the Chinese equity market year to date.
How have you changed the allocation in your portfolio since the outbreak of COVID-19, and which stocks do you currently prefer in the current market stage?
The coronavirus has clearly led to significant economic shock. And more recently, the tension between US and China is mounting again, which is also not very helpful, but that's not entirely new. What we have done is we have disposed of certain stocks that face deeper earnings cuts in the consumer discretionary sector and the real estate sector. In the meantime, our exposure to the more defensive segments such as consumer staples and healthcare have increased. Overall, we have positioned to focus on companies that are predominantly exposed to the Chinese domestic economy. So currently, we find attractive investment ideas in the infrastructure-related sectors such as construction machinery and cement, as we see demand is increasing very quickly in those areas. The consumer sectors have good quality companies that are showing very resilient earnings trends, notably in the staples segment. Healthcare is another sector that we see strong steers. Disruption to demand from coronavirus is relatively short-lived, and we actually can find companies with good drug development pipeline, but that are currently trading at discount in this environment. We also like some of the internet companies with online gaming or shopping exposure. They have seen accelerated growth due to more time spent indoors and increasing online penetration. So all those are the areas that we managed to find new opportunities in.
So I've seen you hold less than 40 stocks in your portfolio. So I would regard this as a highly concentrated portfolio. So what are your criteria for choosing investment opportunities? How does your investment process look like?
We favor good quality companies with improving operating momentum that are trading at a reasonable valuation and are receiving increasing investor attentions. Our investment philosophy is trying to look through behavioral biases by searching for stocks that combine the four factors of strategy, earnings, value, and technicals. Our starting point is an objective computer screening process that quantitatively measures and ranks all the stocks in our investable universe. We then carry out our in-depth fundamental research and analysis on the top quartile of those stocks. And then we would select the top 30 to 40 stocks to construct a concentrated, high conviction portfolio with risk awareness. So that's how our investment process works.
So in your portfolio, Tencent and Alibaba, like in many other Chinese equity funds, have a large stake. Which of this is by conviction and which is due to some index weighting considerations?
We have strong conviction on both Tencent and Alibaba. Both of these companies are leaders in China's internet space, and they are both generating 20 to 30% revenue growth, which is quite interesting in this environment. Tencent had strong revenue growth in gaming and in advertising during the last quarter, although that is helped by the lockdown effect on the back of coronavirus. But we think some of the short-term momentum actually may last longer as Tencent's user base actually managed to expand further. In the long term, there is still room for growth in its gaming business and its advertisement business. And also, we think its payment business is currently undervalued. The stock is trading at similar multiples to its historical average, so it's not really expensive. And meantime, Alibaba has a dominating position in China's e-commerce business, and it also has a stronghold in cloud and in payment businesses. All these are the areas that still have a lot of growth potential. It has also posted better than expected results in the last quarter, and valuation for Alibaba is also not demanding. Although I have to admit that the index weight is a constraint, as we're not allowed to own more than 10% in individual names, which actually limits the extent to which we could express our conviction level in the holding of these two companies, because Tencent itself is 9.5% and Alibaba is about 12% of the benchmark index. But luckily, China is a big enough market with a diversity of investment opportunities, and internet is a space that offers strong structural growth. Besides Tencent and Alibaba, there are other internet stocks that have compelling investment cases that we could invest in. And at the same time, we also find more than 30 other attractive ideas outside of the internet space with a variety of growth drivers, such as high-end liquor, home appliances, construction machinery, or property management, etc.
So we've seen there's some high weighting in cyclical consumer stocks in your portfolio, but you're somehow underweighted in financial services and real estate. So where's this coming from?
The impact of coronavirus on global economy, we think, is yet to play out, and the tension between US and China has been mounting again. So far, I think there is very little evidence to support that the timing is mature for a cyclical recovery. We are fundamental investors, and we are better at looking for evidence bottom up rather than trying to forecast macro or geopolitics. Just looking at the two sectors that you mentioned earlier, the banking sector in China at the moment is facing net interest rate margin pressure and also deteriorating asset quality. The real estate sector suffers from high leverage and also FX fluctuation. So in both sectors, there are only a few companies that are attractive names to own for the long term. Our investment approach is very bottom up instead of trying to do top down sector allocations. From a fundamental analysis point of view, using our 4-factor investment framework, we have been looking for good quality companies with improving earnings and technical momentum that are trading at a reasonable valuation level. And on those bases, we have been finding more attractive investment opportunities in other areas outside of financials and real estate sectors.
This was Wenchang Ma, portfolio manager from 91 Asset Management. Thank you very much, Wenchang, for being here today with us and sharing your views.
Thank you very much. My pleasure.